Hey everyone, welcome to another video on my channel, and today in this video we are going to talk about a slightly different aspect, and that is about investing. So generally you might have seen me do a lot of trading videos, but today I want to make a video on investing and how exactly the entire world has transitioned from analyzing or valuing companies based on the assets to earnings to future growth potential. So I want to take you through the timeline on how exactly the entire concept of valuation evolved. Investing was not really fancy until the time of 1900s or 1920s. So till then only few of them really participated in the stock market. There were only an elite class which actually used to take their money and put it in the markets. Obviously markets were also not so evolved. And post World War I, that is in 1918, slowly the interest towards investing started to grow. So the markets in US started to rally quite a lot post the World War, and you already know the decade between 1920 and 1929, markets saw one of the biggest rallies ever. So this was fueled by two or three factors. The first factor is a lot of retail participation took place, and the second factor is even that was the first time where women also entered into investing, and third time there was also margins given on stocks. So all this fueled a fantastic rally in the stock market. During 1929, we saw the biggest crash ever where the index itself fell 90% from its peak and the entire world went into a Great Depression. So this is one of the worst crashes the entire world has ever seen in easily past 2 or 3 centuries, right? So even the 2008 crash was hardly around 60%, but this was almost around 90% from the peak, right? So once this crash happened, so slowly the people's interest towards investing started to go, and the entire new era of investing started to come in, that is value investing. So people didn't want to buy at random prices, so they wanted to see which company actually had the value and wanted to invest in that particular company. So it was only post 1930 or after the Great Depression, slowly when people started to gain back confidence in the market, that is when the entire concept of valuation started to gain popularity. So now people no longer wanted to buy at random prices, they wanted to make sure that they paid the right price for the stocks. So now let's go back to the time of 1930, 1940 or even maybe somewhere around 1900s. So let us try to analyze the kind of industries that existed. So mostly it was power which was gaining popularity. It was also the industrialization which had happened. So industries like steel, petroleum started to gain a lot of popularity. Apart from that, it was even the automobile industry which gained a lot of popularity. So you can see the kind of industries which were really doing well. It was heavily asset based. Another industry which really did well was obviously the banks. So if you see banks, if you see any big metal industry, petroleum industry or anything of that sort, so you see that all of these industries are asset heavy, right? So for example, a metal mining company will have a lot of assets, a bank will have a lot of assets, so will a big industry which is manufacturing a lot of things, let's say defense or any other parts, will also have a lot of asset. So this was mostly an asset driven economy. So the more assets you had, the more you could produce and more your company could grow. So this is where the entire concept of price to book value started to gain popularity. Price to book value essentially did a very basic thing. It compared all the value of your assets minus your liability and compared that to the value of the company. So people were ready to pay up to 1, 2 or 3 times price to book value, and anything over that was considered to be very expensive. People were not ready to pay more than 2 or 3 times the company's assets. Back then, your revenue was more or less directly proportional to the kind of assets you owned. So slowly when we started to come from 1930s, 1940s towards 1970s or 1980s, things started to change. So slowly the economy started to move towards or shifting towards technology than being asset heavy. So what exactly happens with respect to technology? So here you don't really have to own a lot of assets. Let me just give you an example. Let's say you have a software company, a small software company, let's say with around 10 to 12 employees. You take around 10 to 12 computers and you start working. So now when you actually take a look at the overall assets you own, it will be hardly anything, just around 12 computers. But what is the real deal here is that your software can generate much more revenue without having any asset, just by sales and subscription. So you can see when it comes to a software company, the entire dynamic changes. You no need to have any big assets to really generate revenue. So for example, in case of Microsoft, in case of Apple, in case of Google, you can really see the amount of profits or revenue they earn versus the total fixed assets they have is hugely disproportional. So let me just show you some examples. So with the Indian context itself, so I'll show you some steel companies in Indian context and show you some tech companies in Indian context, which is going to give you a very good idea. So now I will just open Tata Steel, right? So you can see when I just scroll down, the kind of assets Tata Steel has, right? So it has a reserve of almost around 87,000 crores. So now when we scroll down to the balance sheet of Tata Steel, you can see they have a huge amount of fixed assets, almost close to 1,41,000 crores of fixed asset, and they are generating a revenue of 2 lakh crore. So you can see that as and when the company is growing, they are also accumulating quite a lot of fixed assets. So from the same Tata group, now I will open Tata Elxsi. So this is a technology based firm of Tata itself. And now when I come to their balance sheet, so what you see right over here, the fixed asset in terms of overall asset is quite less, hardly around 384 crores. But when you actually take a look at the net profit or even sales, so for example, their sales is around 3,400 crores, which is 10 times of their fixed asset. And you can also see their net profit itself is almost 3 times of their fixed assets. But the same thing cannot be seen for the Tata Steel company, because Steel company is heavily asset driven. So when we take a look at their overall fixed assets, it's around 1,41,000 crores. The net profit or sales for that matter is not much deviated from the total value of their fixed assets. So this can be seen true in many cases. If you actually open, for example, an automobile industry, I will open Tata Motors itself. And when you come down, so you see that Tata Motors again has huge amount of fixed assets, almost around 1,40,000 crores, because they need big manufacturing plants to manufacture a lot of cars. You might have a very big demand for cars, but what if you don't have the enough manufacturing facilities, right? So this led to a whole new way of valuing companies. People were no longer interested in looking at the asset, but they were interested in looking at the earning potential. So when you take a look at the tech company, for example, Microsoft, right? So they can have the same amount of employees, they can have the same amount of systems, but they can just sell more amount of software and generate bigger chunk of revenue, bigger chunk of profit. So now people were more interested in earnings compared to looking at the value of the asset alone. So this is when the PB ratio or price to book value slowly started to become irrelevant, because people were now looking at how much the company earned rather than looking at what kind of assets the company owned. So this is when PE ratio started to become more popular. So what we have to understand is how the nature of the business is, right? So even today, a lot of people assume tech companies are overvalued just because they have high PB ratio, right? So you have to understand what ratio to be used where. So it doesn't matter whether the tech companies have high PB ratio or not, because they don't need a lot of assets to generate revenue. So till now we discussed about how exactly companies were being valued based on the asset, that is PB ratio, and earnings, that is PE ratio. But today the valuation metrics are slightly being changed. It is not the case that it is being used today for the first time. It was being used even previously, a decade ago or even 2 decades ago, but it was not as prevalent as today. So what is this new valuation metrics are we talking about? That is the future growth story. So previously it was only dependent on what the company used to report. But today we are looking well beyond that into what the company can actually become. So when you take a look at the best investors like Warren Buffett or Rakesh Jhunjhunwala, this is something which they used to predict really well. Rakesh Jhunjhunwala sir predicted the story of Titan really well, whereas Warren Buffett also predicted the story of Coca-Cola really well, because of which they were able to multiply their wealth. Not just this, even most of the angel investors or VC funds during the early 1990s and 2000 actually bet on the companies based on the future growth potential. So even if you go 1 decade earlier, a lot of people would still believe that the valuation was purely based on PB ratio and PE ratio. I myself know how entire thing has changed, because even if you take out any textbook for that matter, everywhere they say that PE ratio is one of the most important valuation metric, right? So our textbooks haven't evolved, but the entire way the market works has evolved. So today if you take a look at Zomato hardly has a sale of close to around 9,000 crores, no profit, no big assets. Still, the company is valued close to around 1,35,000 crore in spite of having a loss from the day it started with no real big fixed assets. So this is almost close to 13 to 14 times its sales, right? So is this justified? So we really don't know, right? So today the market is valuing based on how Zomato can turn out to be the #1 food delivery app, and going forward the size of Zomato can also be multifold, and that's the reason market is ready to pay that value today. Is it going to happen the same way market expects? That is something which we have to wait and watch. But what we can definitely see is how exactly things change over time. So my most important advice to you would be not to get stuck with a particular valuation metric, right? So whoever really thought that the PB ratio was the way to measure things, it is because when I started to read about investing, so I obviously came across PB ratio, and I really believed that PB ratio made a lot of sense, and it does make a lot of sense. But when you actually try to understand PE ratio in detail, even that starts to make much more sense. So now, since I am more used to looking stocks with PE ratio, it will become natural to me whenever the PE ratio becomes very high, let's say 60-70, the stocks seem to be very expensive. So if the PE ratio ends up becoming really high, you start to feel the stock is really expensive, right? So what we have to definitely do is maybe start looking beyond the ratios alone, because numbers are only from the past. So what the company really holds is in the story what you believe in, right? So the thing is, maybe if you had asked in 1970s or 1980s, 10 people will come out with 10 different stories for Titan, right? So it might also have happened that even Rakesh Jhunjhunwala wouldn't have expected Titan story to turn out the way it did, right? He might be expecting 10 times lesser, or even say 20 times lesser, but it turned out to be 20 times much more than what he really expected. So these are some stories which you can't really predict the future, but if you feel that the opportunity is there, you can actually look well beyond the PE ratio metric, right? So don't get stuck to a particular valuation metric, because one more example is if you take examples like 3M or Nestle for that matter. So these stocks always trade at a very high PE, easily over 50 and 60, and they continue to do so even today. In spite of this, they are able to deliver a constant and a continuous growth. The entire valuation is now mostly moving towards the metric of the story and how big the company can become than what it is today. So you can, on the other hand, see companies like HDFC, which are reporting very good profits, are not being appreciated by the market, but some stocks which have very little profit, the market is literally taking them up as there is no tomorrow. So for that matter, if you take a look at HDFC Bank, today it is valued around 12 to 13 lakh crore. Right? So if you take a look at HDFC Bank, it is almost around the 5th or the 6th largest bank in the world. So now if you take Indian economy, right? Indian economy is almost around 3 trillion heading towards 4 trillion, right? 3.7 or 3.6 trillion. So if you see Japan is much bigger than India, almost around 2 times bigger, even Japan and Germany for that matter. If you take a look at China is 5 times to 6 times bigger than India. And when you take a look at USA, so US is almost close to 10 times bigger than India. How can it happen that our bank is worth more than any bank in Japan, which is 2 times our size, or any bank in China, which is 5 times our size, or almost half the size of JP Morgan, which is the largest bank in USA, which is 10 times our size? And if you take a look at HDFC Bank, it easily is worth more than most of the banks in US, where the economy itself is 10 times more than us. So I am not telling that HDFC Bank cannot grow, but it is just that the potential for HDFC Bank from here is slightly lesser. It can grow maybe at 10%, 12%. So can we expect the growth to continue at 25-30% like how it did previous 2 decades? Maybe no. We have to be open to the ideas that it may or may not happen, and not believe based on the past story. So we had a fantastic run in HDFC Bank doesn't mean that it is going to continue the same way. The way people perceive things changes decade over decade, and it is important for us to be open to new ideas. So this video was mostly done because I wanted to tell that how exactly I have changed my mind over time. So before, I used to only see price to book ratios with 1 to 1.5 to purchase a stock. So when I say before, almost around 6-7 years ago. Later, I shifted my approach towards consistent compounders, where let's say HDFC, Asian Paints, Pidilite. So this worked really well for some time, but last 2-3 years it turned out to be really bad decision. So if I am not open to different ideas, so now I am going more towards small cap and mid cap, which has a potential to grow. So that's the reason I am still able to maintain a decent return on my portfolio than sticking to a single idea which might have performed in the past and which might not perform going ahead. So make sure you are adaptable in the market, and as and when things change, you should also end up changing your approach. I hope this video was useful. The entire story on how the valuations changed was just to give you an idea that what people valued maybe in 1950s, 1960s. So within 2-3 decades, that lost complete value. So no longer people really bothered about price to book value, and they started shifting towards P ratio. So something similar can happen today, something similar can happen a decade later. So we should be open to change. So if you have found this video insightful, make sure to hit the like button, share this video, and subscribe to my channel. Thank you so much for joining.